The benefits of a whole life insurance contract. Listen, they're loaded with guarantees, primary guarantees and secondary guarantees. You put money into the policy in the form of a premium, and the issuing insurance company guarantees the cash values and the future death benefit. The guarantee is backed up by their claims paying ability. Well, there are also secondary guarantees. They're provided by the states, the individual states, through the state guarantee associations. Control, it's a private contract, right? You own it, you control it. Now think about that. Sometimes, not always, but sometimes control is better than ownership, right? If I can control an asset or own an asset, which is better? Well, it depends on the situation. Sometimes control is as good as or better than ownership. But with a life insurance contract, with a whole life insurance contract, the owner has control of that policy, guaranteed by contract. Dividend-paying whole life or whole life insurance has a guaranteed cash value. The cash value is made up of two parts, guaranteed interest and non-guaranteed dividends. So the interest is guaranteed, right? No matter what. The cash value earns interest every day, forever, compounding, 24 hours a day, 7 days a week, 365 days a year, year over year over year, even on weekends. All right, think about that, earning interest every day. And then the non-guaranteed component of the cash value is the dividend. Well, we've kind of got to consider what a dividend is. Well, a dividend is the experience of the company. So if the company has a profitable year, they experience, good profits for the year, or they experience a profitable year, then they pay a dividend to the policyholders if it's a mutual company. Now, the dividend is classified as a return of premium under the Internal Revenue Code, so therefore it's not taxable. Well, perfect. I don't care what they classify it as. Just pay me a dividend, okay? And then you look at the cash value. What is the cash value of life insurance? The cash value literally is the net present value of a future death benefit minus the future premiums. Right? It's very simple. You pay a premium. Part of that premium accumulates internally, and it accumulates as a cash value. The cash value grows at guaranteed interest rates and dividends that are not guaranteed, but that is an accumulating value. The cash values accumulate forever. And so if you consider too, what is the company doing whenever you pay the premium? They've got to put a portion of that premium. I mean, there's expenses, no question, to creating a life insurance policy, distributing that product. And we all know that the consumer pays for everything, right? There's nothing new about that. But look, part of your premium goes to cash value. That cash value, the company has to put to work to meet future obligations, which is the death benefit, your death benefit, right? And the future cash values. So the companies, they have to be very conservative. They put that money to work at guaranteed interest rates and guaranteed payback schedules. But you as the owner have control of that cash value as it relates to your policy. Why? Because contractually, you have the right to access that cash value. And you can do that through withdrawals or loans, collateralization. Right? Now think about that. I can get mad and quit and withdraw my cash value and collapse the policy. It doesn't exist any longer, but I've got my money out of it. Or I can, by contract, collateralize that cash value. So if I do that, if I borrow from the insurance company, collateralizing my cash value, that cash value is still earning interest and dividends forever. I'm not interrupting that compounding. Because it's a contract, right? The life insurance is a contract. There's a lot of things you can do with that cash value. You can take the cash value and make it pay its future premiums. It's called premium offset or paid from policy values. I don't want to use a bunch of, industry jargon, but I have control over that policy, right? So I can use the cash value through withdrawals or loans, and I can use it to do anything I want. If I didn't want to pay a future premium, I could make that cash value pay its future premium. It's just premium offset or paid from policy values. I can start and stop that, right? The tax treatment of cash value is literally and technically and legally tax deferred. If I put money into the policy, it starts accumulating a cash value. That cash value is going to accumulate tax deferred, but I can also access it tax free, right? So if I let it accumulate, compound and grow and build, I can withdraw it. Withdrawals from a life insurance policy are tax free up to my basis. My basis is just what I paid into it. Then if I withdraw above my basis, I'm taxed at ordinary income on those withdrawals. Or I could switch to loans. I could withdraw the basis and then switch to loans. Loans are not taxable. So the cash value is accumulating tax deferred, but accessible tax free. And the death benefit, of course, is always the death benefit is typically always tax free. There are some circumstances with structures of a policy that the death benefit could be taxed, and we'll talk about that in a minute. But if you look at the cash value accumulation, it really comes from two components. One component is a guaranteed cash value that earns interest every day forever while that policy is in existence. And then dividends are paid from the company, generally on an annual basis, and the dividend is not taxable. It's classified as a return of premium under the Internal Revenue Code, and I don't care what they classify it as long as I earn a dividend. That's what I want, is I want to earn the dividend and I want to earn the interest. And then if we look at the dividend, me, the owner of the policy, I have several options that I can exercise when it comes to that dividend. I can take the dividend in cash, right? I can leave the dividend to earn interest at the company. I can take the dividend and reduce premiums. I can take the dividend and reduce an outstanding loan balance. I can buy, term insurance with that dividend internally. Or I can plow it right back into that policy, straight into the paid up additions rider, and then just enhance the compounding, accumulating effect of that cash value. That's really what you want to do once you understand how a life insurance policy structured for cash works. And let's consider this on the dividend, right? Even though a dividend is not guaranteed, once the dividend is earned, the value of that dividend cannot go down. That's very important. Let's consider a dividend from a stock. Let's say I bought a stock from XYZ company. Right, I could take the dividend in cash, or I could put it into a DRIP, right? A direct reinvestment program. So if I got paid the dividend and I'm in a DRIP program, I'm going to buy a fractional share of that stock. Okay, well, what's the future value of that stock going to be? I don't know, and you don't know either, right? Even the company might not know. Of course they don't know. So if I bought a fractional share of stock with the dividend, that stock value can go up or down. So you could lose value, right? And it's directly related to the dividend. The dividend, I got paid the dividend. I bought a fractional share of the stock value went down. Didn't the value of my dividend decrease? Yes. Is that always going to happen? No, but it cannot happen in a life insurance policy. Once the dividend is earned and paid, I don't care where you put it, right? If you put it into the paid up additions rider of the policy, it cannot go down in value. That's pretty powerful. The tax benefits of life insurance, if you look at that, the cash value accumulates tax deferred. It's accessible tax free. The death benefit is tax free. Now that's if it's structured correctly and the premium is paid with after-tax dollars. I hear an awful lot of the times, well, can I get a deduction to pay the life insurance premium? Well, why in the world would you want to do that? If you get a deduction to pay the premium, then the benefits are going to be taxable later. Right? That's exactly what you want to avoid. Pay taxes on your money one time and move on. So the tax treatment of cash value is tax deferred, and then the cash value, though, is accessible, tax-free, then the death benefit is tax-free as well. So if you look at it and consider the power of the death benefit can give the owner permission to spend the cash value or other assets other assets. Think about that. You have an IRA, a 401k worth $1 million. You saved it up for your retirement. You got a tax deduction to put the money in, but now you've got to pay taxes as the money comes out. Well, once you spend that $1 million, what happens? It's gone. Well, if I had $1 million in cash value, I can spend that cash value and still leave a remaining death benefit. And so if I have life insurance, maybe I didn't die early, right? I didn't die prematurely. I lived a full, long, happy life. That death benefit can give the owner permission to spend assets. So they don't have to go through that decision-making process. Well, should I go with less today so I can leave something for my children or my grandchildren? No. You give it away to your grandchildren, enjoy it while you're alive, and leave a death benefit. It should give the owner, or can give the owner, permission, right, to spend assets they might not otherwise would have spent. That's freedom. Then if we consider another benefit of life insurance, whole life insurance, there's some contractual guarantees that exist in whole life insurance that do not exist in other life insurance types. Okay? There's what is called a non-forfeiture option or non-forfeiture options. One of them is the contractual right to take a reduced paid-up policy. That does not exist in any other form of life insurance. So I have a cash value. I can exchange that cash value for a paid-up life insurance policy with a reduced death benefit and still have some cash value. That's very powerful. I can take extended term, and there's some other options. My point is there's some guaranteed abilities and options with whole life insurance that does not exist with universal life, term life, etc. And then, of course, there are other benefits through riders that you can use, pay for, and enjoy. Long-term care riders, waiver of premium riders, other insured riders. There's other benefits that you can attach to a whole life insurance policy. Long-term care riders, those are worth investigating on their own. And then, so summary. In summary, whole life insurance is a contract. Well, contract is the basis of our society, and it's a unilateral contract. Einbahnstrasse, right? The company can't change anything about that contract. Me, the owner, I can change some things, very limited on what I can change, but it's a private asset, so I can change ownerships, I can change beneficiaries, but I'm limited on what I can change. The insurance company can't change anything. And then cash values. Guaranteed cash values. There are primary guarantees and secondary guarantees. Primary guarantees are given by and backed up by the claims paying ability of the company. So the guarantees are provided by the insurance company who issues the policy, right? And it's backed up by their claims paying ability, their assets. Well, the secondary guarantee is provided by the state guarantee associations. Pretty powerful. Primary guarantees, secondary guarantees. And then I have the opportunity to earn a dividend, a tax-free dividend that I can use to accelerate the power of my policy. Holy moly, that's worth looking at. Then the tax treatment of life insurance. If I pay with the premium with after-tax dollars, which is what should happen, which is what you should do, right? The money, the cash value inside the policy grows tax deferred. It's accessible tax-free. The death benefit is tax-free. Then I have the guaranteed non-forfeiture options. I have guaranteed rights and abilities in that contract that does not exist in other companies. And then, of course, you can add other additional benefits to that through riders that have cost, but the value that you can add to policies with these riders is well worth the cost.